Good afternoon, everyone. I thank the Chamber of Tax Consultants for giving me this opportunity to share my views on a subject that I never knew existed till I was contacted to deliver a presentation. And my first reaction when Paresh contacted me was, I said, what is there to speak on this? Something, maybe it can get over in 10 or 15 minutes. I also thank all of you that after the high decibel election season that we have been witnessing, and even after the voting is over, you have still chosen to listen to me, because obviously this election season has been something where people are now feeling a real fatigue about listening to so many things which we would rather prefer not to listen. I must admit that Paresh has also given me certain valuable suggestions, because I worked and reworked on my presentations maybe 3-4 times, and thereafter I sent it to him, and then he made certain suggestions which I incorporated. So I also thank him for that in absentia. At the outset, I will clarify that this is a presentation which is limited in its scope only to individuals. Because when we talk of change in residential status, it is something which would normally be a case only in case of individuals. So as far as the overview is concerned, what I intend to cover is a recap of the residential status, where we'll look at both how a person is considered a resident and also how he or she is considered a non-resident. Then we look at the transition aspect. That's where a resident becomes a non-resident or a non-resident becomes a resident. Then we look at the implications in both the cases with respect to assets and liabilities in India of a resident who has now become a non-resident, and assets and liabilities outside India of a non-resident who has now become a resident. And then there are certain planning, care and caution pointers, and as I mentioned, they are merely pointers, because this could be individual case specific, and therefore one can only mention that yes, if you come across this kind of a situation, then you may need to look at these aspects also. And really speaking, those aspects are not part of FEMA per se, and so I can safely say that they are out of syllabus as far as I am concerned. Now we take up the recap of residential status. It is section 2V, subclause 1 of FEMA. It says, an individual who has resided in India for more than 182 days. Now there are two parts to this section, this clause. So what I have done is, the first part is the quantifying criterion, or let's say the arithmetic criterion, because it deals with the specific 182 days. So we look at whether it was more than 182 days or whether it was less than 183 days. Now, this when or for which period is this 182 days to be looked at? So it is unlike our Income Tax Act section 6. Here, where we look at that particular year, here we are looking at the preceding financial year. And financial year is 1st of April to 31st of March. Today we are, say, on 25th April. Now if we need to examine what is the residential status for the financial year 2014-15, then we will be looking at the period 1st April 2013 to 31st March 2014. So, in a way, here we are looking at a prospective situation. Prospective means that it applies to the year in question. Now, as far as income tax is concerned, Income Tax Act section 6 is concerned, at least the earliest you may be able to determine the residential status is not before 30th of September. Because that's the time by which you will have an idea whether that person is going to be staying in India for that minimum period or not. And of course, there are several other aspects relating to either 4 years, number of days stayed during the 4 years or 7 years, etc. Whereas here we are looking at a prospective situation, so on 1st of April, we can determine what will be the residential status of that person during the entire year. And this status applies for the whole year. After having determined about the number of days under the quantifying criterion, there comes the second part where we look at the qualifying criterion. And there are two qualifying criteria which create the exceptions to the quantifying criteria. In other words, we have two situations. The first is where it is more than 182 days. The second is where it is less than 183 days. So if we are in the second situation where the number of days stay is less than 183 days, let's say it is 90 days, then we don't need to go to the qualifying criteria and we'll look at only the quantifying criteria. So if it is less than 90 days, so that person has not resided if that person is resided for say 90 days, that means that he will be treated as a non-resident. Now, these two quantifying criteria, of that, the first one applies to a person who is going outside India, that is an emigrating person, and the second applies to a person who is coming to India, that is a returning person. Now what does the first criteria, that is capital A, which applies to the emigrating Indian, say? A person who has gone out of India or who stays outside India for. Now there are three purposes which are mentioned there. A, employment, for taking up employment outside India, or taking up business or vocation outside India, or in such other purpose and circumstances as they indicate that the person desires to stay outside India for an uncertain period. So assuming somebody leaves India, say on 1st of December, and right from 1st April, in the preceding financial year, that is 31st of March 2013, 1st of April 2013 to 31st of March 2014, he was in India for more than 182 days, and on 1st of December 2014, he leaves India. For any of these three purposes, he will be considered a non-resident from and from the date when he leaves India for these purposes. So we take a situation where someone, say in July, went on a 1-month tour to Europe and came back, and thereafter in December he leaves, say, for taking up employment in US, then he will be treated as a non-resident only from December and not from June. In fact, this concept is very important. So in case any of you has any doubt about that, we can clarify it right away, because there is something, as I have always realized, that there are two aspects in FEMA. One is the residential status, and second is the nature of transaction. So if you have once mastered these two aspects, that means you have really mastered more than 50% of FEMA, because thereafter you only need to look at the relevant regulations and then find the answer. Now we come to the second aspect, or rather the second exception, that is capital B, and this applies in case of a person. I think it should, there is a typo here. It says, or who stays outside India, actually who has returned to India. So, for employment out, I mean, what has happened is, I think that's probably the copy-paste virus which has come in, because everywhere where it says outside India, it should read as India, and is otherwise. Rather, I think it will be better for me to actually read it out. Says a person who has come to or stays in India in either case, and then otherwise then employment for or taking up employment in India, or for carrying on in India a business or vocation in India, or for any other purpose in such circumstances as would indicate his intention to stay in India for an uncertain period. So wherever that four places outside comes in, it is actually in India. And in the beginning it says otherwise then. So if a person who was staying outside India comes to India, otherwise then for any of these three purposes, then even if he has stayed in India for a period of more than 182 days in the preceding fiscal year, he would still be termed or treated as a non-resident. Illustratively, let's assume that a gentleman arrives in India at tourist. While in India, he falls sick and has been admitted to the hospital, and for whatever reason he cannot be shifted, and he is required to stay here for a period of about, say, 2 years in the hospital. The point is, because he has stayed in India for more than 182 days, does he become a resident? Correct. He does not, simply because the purpose for which he stayed in India was otherwise than A, B and C, and therefore he will not be considered a non-resident, a resident on that ground. And then we look at who will be considered a non-resident, and that is section 2W of FEMA. So a person who is not resident in India is a non-resident. Generally, the residential status is for the entire fiscal year. So this basically I am just summarizing that it is basically the residential status is for the entire fiscal year. So as I mentioned earlier, in a way you can determine even on 1st of April, except where the exceptions A or B kick in, because there is only situation in which it will not so happen. And qualifying criteria A and B are exceptions to this proposition. So to summarize, qualifying criteria capital A applies to a person emigrating, and qualifying criteria B applies to a person returning. Now we look at the transition aspect. In transition, there is a change in residential status where a resident becomes non-resident and a non-resident becomes resident. And then we will be looking at, in the context of both these situations, we will be looking at the implications vis-a-vis the assets and liabilities. Generally, the assets and liabilities would be, say, movable assets and non-movable. In movable, say it is bank accounts, shares, debentures, etc. Then there are businesses, it could be proprietorship, partnership, and then insurance policies. And in immovable, you could have residential, commercial, and agricultural plantation property, farmhouse, etc. And then liabilities. Okay, now we come to the first situation, that of a resident becoming a non-resident. Here, a general permission has been given in section 6 of FEMA. It is subsection 5. Now subsection 5 gives a general permission to hold, own, transfer or invest in Indian currency, security or immovable property that was held or owned when the person was a resident. So if someone who was a resident becomes a non-resident, by virtue of the general permission in section 6.5, he will be entitled to continue to hold on the assets that he was owning when he was a resident. Of course, the scope of section 6.5 is wider than what is mentioned here, because it also applies to the case of a non-resident who has come to acquire assets through inheritance from a person who was a resident in India. But since we are looking at a transition situation, here I have confined this only to our transition situation. Now we look at specific assets. First come the bank accounts. So what is required to be done? The non-resident will be required to intimate the bank with which he is holding accounts to designate those accounts as NRO account. Now here, practically, it will depend on what procedure each of the bank follows in this respect, because earlier banks used to merely kind of, one can say, they simply cancel out on the passbook the savings, and then they simply term it as non-resident ordinary, that is NRO account. But I think after this computerization is coming, the banks, at least some of the banks, have been known to close the earlier account and open a fresh account. So it is up to the bank how it is going to deal with it. There is nothing like as such a set criteria or anything. Only requirement is that it should be mentioned as a non-resident account. Yeah. Pardon? So if it is a joint account, then as far as if the first holder becomes a non-resident, then it will have to be termed as NRO account. And if the joint holder is a family member, then that joint holder can continue to hold that account. Now, after that person becomes a non-resident, out of the balance in the NRO account, he can repatriate up to $1 million during each financial year from that account. So if someone has that kind of a balance lying in the account, or he has certain assets, and if he has sold those assets and those proceeds have been deposited in the NRO account, then out of that amount can be repatriated. So even to take, but then it can be done so provided the account is an NRO account. So even for this reason, it is absolutely imperative that as soon as a person becomes a non-resident, he should take steps to ensure that his accounts are designated as NRO account.
Excuse me, suppose for some specific purpose, the amount which is required in a financial year exceeds 1 million. So for that, any approval can be given for it?
No, because at least practically RBI is not known to entertain any such request, and they are very, very clear that they would not like to allow any person to repatriate more than $1 million. The second aspect that needs to be borne in mind is that if any investments are made using the funds or the balance in the NRO account, then those investments will always remain non-repatriable. Now when we say non-repatriable, earlier there was a concept of total non-repatriation, and the standard language which used to be employed by RBI was that neither the income nor the sale proceeds from the investments will be allowed to be repatriated. However, I believe since 1997, RBI slowly liberalized the rules, and since then they have been permitting full or absolute repatriation of the income, because income is being considered as a current account transaction, and as per India's agreement with IMF in 1991, India had committed to liberalize the, bring in total liberalization insofar as current account transactions was concerned. So today, even though it may say this is on non-repatriation basis or without repatriation benefits, that would mean that the non-repatriation applies only to the sale proceeds and not to the income. So if someone is holding investments, assuming by way of shares, and dividend is being received, or bond investment in bonds and interest is being received, then that dividend or interest is fully repatriable, and it is only the sale proceeds of the shares or the bonds that is non-repatriable. But even out of that, up to $1 million can yet be repatriated on an annual basis.
Sir, to clarify, if I am holding money in fixed deposit,
yes,
and I liquidate that fixed deposit, put it in current account. So fixed deposit was on investment account, which I liquidated, put it in my savings bank account, and from that I make remittance.
Up to $1 million.
Up to $1 million.
No, but then see, now
So then it's a question of capital account and current account both getting used.
no, because fixed deposit in any case goes your capital account. So it remains as capital only. It is only the interest on fixed deposit that is your current account.
That means in a year, if I am earning say 10 lakh rupees as interest,
Yes.
and I have another $1 million plus 10 lakhs I can remit.
Yes.
For my NRO.
Yes. In fact, there are practical instances of several industrialists who have become non-residents, in whose case, industrialist promoters, in whose case the remittance on dividend from the dividend may run into millions of dollars. But as far as the sale proceeds of the shares are concerned, it is only $1 million.
So you could have part A and part B both together, which can exceed 1 million. Part A being capital, which is restricted to 1 million, and part B being income generated during the year,
Yes.
which can be any amount.
Yes.
Let's say during the year, let's say 2 or 3 years, the capital is, the current account transaction has been cumulative. Can I remit the entire money or?
So on that, as such, there is no clarity as such, but my personal view is that a current account transaction retains the character of being a current account transaction forever, as long as I can establish that this was, let's say, income on my investment and which I have not earlier repatriated. So if I can establish that, then according to me that should be possible to repatriate.
In the bank, will the bank allow beyond 1 million?
Pardon?
In the bank?
No, because the bank will insist on obtaining a CA certificate. So then the CA will have to certify that yes, this is something which has come out of this income, and this is something which has come out of sale proceeds. And from a practical perspective, it may even make sense to have, because when we talk of this possibility, it is obviously where the amounts are substantial, obviously much more than $1 million annually. So then it may even make sense to have two separate accounts. So one account where the income goes in and the other account where the sale proceeds go in.
Consider capital gain also as current account?
No, because capital, see what it refers to is sale proceeds. So capital gain is sale proceeds. Rather, it is a component of the sale proceeds.
Maturity of NSC, maturity of national state certificate.
That is capital.
But interest component? Interest component is current.
If it is interest, which you can establish as interest, then yes, then it will you can take it out. But when will someone have even maturity exceeding $1 million in NSCs? Now we come to PPF account. So as far as PPF is concerned, the rules under the PPF scheme say that a non-resident can continue to hold the PPF account, or rather a resident who has become a non-resident can continue to hold a PPF account, but only till maturity. So in other words, a non-resident cannot open a fresh PPF account, and once the maturity period is over, that account cannot be extended further, because the PPF scheme allows for extension of matured accounts in blocks of 5 years. So that cannot be done once a person has become a non-resident.
But can he deposit it during his NRI status?
So if you can continue to hold, then as such there should not be any issue about fresh deposit. In any case, PPF scheme requires that you need to deposit
Every year.
minimum 100 rupees every year.
PPF only the residents can.
500, now it is 500.
But PPF only residents can invest. NRI can't invest in PPF. You not open a new account.
But I think the relevant notification, I think it was 2010 notification or something, which basically mentions only about holding it till maturity. It doesn't say anything about not depositing. But I don't know if there is any subsequent one, then maybe I stand corrected to that extent.